Tom Lee is hinting at something absolutely massive coming for markets in the near future. In an interview released today, he kind of outlines this thesis, hints at a couple of very important things, and in this video here, we're going to be going over all of those statements and providing a lot more context and detail on some of the statements that Tom Lee was making so that you guys, the viewer, can be more well-informed going into the market over the next couple of weeks and next couple of months here. So guys, before we get into all of that information, if you guys do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed, turn on notifications so you're notified every single time these videos go live. But without further ado, let's roll the clip.
The markets, let's bring in Tom Lee, head of research at fundstrat and chief investment officer of fundstrat Capital, as well as a CNBC contributor. Last time you were on, Tom, you said, I think we can, and it was definitely one of your, what seemed like outrageous calls at the time. You said, we'd be at 5,500 on the S&P. We should be able to get back there fairly easy. I think we were below 5,000 at the point. We did get close. We got another pullback, but after Friday, we're almost at 5,400 again. What was your reasons for thinking that? I think you just thought that maybe if you see a cat and you keep clapping, it'll jump the first time, but after a while, it finally just ignores you. Is that going to happen with the markets and all this tariff backdrop?
Yes. I mean, I think I know what you're saying, which is I do think markets are getting a little desensitized.
That's what I mean, yeah.
Yeah. And I think part of it is if someone had an investor hat on, not tactical hat, you know, really good opportunities are emerging because the number of stocks below the 200-day moving average was like 15%. Historically, that's a strong buy signal. I mean, you're going to find a lot of bargains there. And the VIX got above 50, and it almost always pays you to buy the stocks when VIX is above 50. But in the near term, it's a roller coaster. I mean, it does feel like we're having a lot of zigs and zags, and even over the weekend. But to me, I think everything that happened over the weekend, including the Sunday further explanations, all of this is still unequivocally positive for stocks.
Interesting. So when we were below 5,000 and you were on the S&P and you were at 7,100, that's like 40%. So you're now, and were you one of the high people on the street at 7,100? Were you there?
Well, our year end originally was 6,600, but we thought we could touch 7,000 mid-year. Okay. I think the 6,600 is still possible, but I do think the 7,100 mid-year is obviously it'd be very difficult to reach. So but it's possible. 6,600
by year end. What about you've made a lot of good calls based on moderating inflation. What did you make those numbers at the end of the week?
Well, I think that if we didn't have to consider tariffs, inflation is definitely tracking below expectations.
I mean, where the Fed wants it, almost.
Yeah. I mean, core inflation month over month at 0.00056. I mean, that's like literally hitting a wall.
Now, is that for good reasons or for bad reasons?
I think it's for the right reasons because...
Oil?
Yeah, well, there's oil and foods off the boil, but it really is shelter is actually cooling to a 2% rate, and that is what you need to get inflation back down to 2%.
So as we all know by now, the situation as it relates to tariffs is constantly developing. We have big statements made. We have those statements being walked back. And again, this just goes to show everything that I've been talking about, whether it be in these YouTube videos or on Twitter, that this new administration is operating with kind of they're kind of governing through uncertainty because they want to be able to play both sides of the fence right now. On one hand, they could slap all these tariffs, these giant reciprocal or they're not really reciprocal tariffs, but on a lot of these other countries and say, okay, we could then generate some significant revenues for the United States and view that as a political win. Or when these negotiations happen and some deals can be made, then they can accomplish some of their political goals. But the only way to continue that type of policy and engagement with a lot of these other foreign countries is to continue to cast out those feelings of uncertainty, which again is not great for the markets in the short term. But as you heard from Tom Lee, again, markets are starting to get used to this type of policy in statements being made from this administration. Now, one of the reasons why the market is moving higher is, again, they are kind of getting used to this situation here, but a lot of what's happening now is the market is viewing this situation and saying, okay, well, if there are to be deals made and some resolutions to be had, well, the overall effective tariff rate can move lower. But there are still a lot of people out there that are talking about the potential inflationary effects of these tariffs. Now, I want to bring you guys over here and take a little bit of a deeper look at the inflation data, because again, you can hear people talk about, oh, inflation's moving this way. There's CPI, PPI, core, headline, all sorts of different ways that you can look at a lot of this data here. And I want to make sure that you guys are kind of understanding what the market is looking at kind of more specifically here. So when we take a look at CPI, again, you can see that it's moving to the downside. We had our readings last week, and they were lower than expectations, which is, again, good for what the market wanted to see. But on the other hand, we didn't necessarily have all these new tariffs in place, so we do have to take this data with a grain of salt. But when you look at shelter here, shelter has been one of the largest contributing components to the increases in CPI that we have seen in the recent past here. And we can continuously see this downtrend here in shelter inflation, which is going to continue to help these numbers move down more towards where the Fed needs them to be. And as you heard from Tom Lee kind of in that video there, this is what he's starting to hint at. If inflation is starting to move down towards the Fed's target, even with these tariffs coming into effect, well, we still have the potential for growth to slow down, which I'm going to show you, and unemployment to increase as a result of this new trade policy. Now, what does that lead to? It leads to the Federal Reserve most likely going to be cutting interest rates more than what we came into this year expecting. So shelter, again, moving to the downside there, which is a good thing to see. And just kind of taking a look at oil over here, oil has moved significantly to the downside, another very, very large contributing component to any inflationary pressures in any given market here. And the thing that the market is the most worried about right now is inflation moving back to the upside as a result of this new trade policy. If you guys look at any consumer sentiment data and a lot of these 1-year, 5-year inflation expectations, well, they're sky high right now. A lot of consumers are thinking that prices are going to significantly increase in the near future. Now, I'll tell you guys right now, we've talked about this many times. I am not of that opinion. I do not think that these tariffs are going to cause a meaningful and material impact to inflation moving to the upside, and I'll cover that a little bit more in this video here too. We've talked about that a lot in the past, but what we really need to be focusing in on here is the potential for that growth slowdown. So when we take a look at, again, we brought this chart up a lot in the past, that this Atlanta Fed GDP estimate for the first quarter of 2025 is still at negative 2.4%. And just today, we did see Goldman Sachs coming out, the CEO, saying that the prospects of a recession have increased. Now, recently, we've also seen Fed Williams over here too, saying tariffs will push up inflation and unemployment. Now, what I want to make very clear to everybody before we kind of break this down a little bit and really make this rate cut thesis a little bit more clear and expand on what Tom Lee was saying, is that when you think about growth, inflation, and unemployment, especially as it relates to tariffs, when you focus in on inflation, remember, it's the rate of change over time. So there could be potentially one quarter where you see a one-time small price increase on some goods that are going to be affected by these tariffs, but that doesn't mean that they're going to continuously increase every single month, quarter, and year after. The other thing that we have to think about is just the normal effects of supply and demand and what could then happen to business activity. When we move over and take a look at consumer sentiment, again, guys, we know that this has been falling off a cliff. The everyday consumer does not have a positive view of the economy going into the end of this year. Now, when we look at this data, we've said this before, I will say it again. When you look at this consumer sentiment data, it doesn't just kind of tell you the situation and the overall feelings of the consumer, but it can also give you an insight into just kind of overall business activity. With the bond market freaking out a little bit, with rates being a little bit higher than what people were expecting them to be, and the overall uncertain nature of this new environment that we are in, well, there is going to be kind of a risk-off nature in a lot of these, let's say, private markets, venture markets, and if capital is not being lent out to a lot of these new and maybe smaller businesses, well, they are going to struggle to grow as well. And when you have consumer sentiment already as low as it is right now, and consumers as a whole still very, very upset about all the price increases that they have seen across the board, well, if you start to see some price increases yet again, well, it is going to lower demand for a lot of these goods that could witness some of those higher prices. So then what happens next? Well, if a lot of these corporations are going to still want to sell the same amount of volume of their goods, they are going to need to keep prices the same, but their margins are going to shrink. Now, what happens when a company's margins shrink? Well, they're going to need to take some actions in order to kind of boost free cash flow and be able to continuously meet these earnings estimates that they have set out for themselves. So what happens then? You could see some layoffs across the board, and you could look over here at unemployment, and this could start to get a little bit out of hand. So when everybody is focusing in on a lot of these potentially inflationary effects of tariffs, what you really need to be focusing in on a little bit more is what is actually going to happen to growth this year, and how is that then going to affect unemployment, because all of those different elements are going to feed off of each other, and if there is not enough demand for these goods, prices will not increase, and you will not see these giant inflationary effects that people are talking about, and that is going to lead to a rapidly deteriorating situation in the economy, and the Fed will have to step up. Remember, markets stop panicking when central banks start panicking. So again, don't just take my word for it over here. We already have some of these Federal Reserve members already kind of outlining their plans that they are willing to intervene if market issues start to arise. Just at the end of last week here, Federal Reserve prepared to intervene in financial markets if liquidity issues arise, says Boston Fed president. Now, again, we talked a little bit about sentiment as it relates to the consumer and overall business activity, but you also have to think about it in the global scale here, where when we have a lot of these uncertain developments happening in the United States in the present, well, a lot of these foreign investors are not really going to feel comfortable placing their money in U.S. markets in the short term here, which is exactly what we've seen. We've seen a lot of sales in the bond market. The bond market is looking a little bit better today. We've seen some aggressive moves down in the equity market. But again, I think we all need to remember that this situation is going to continue. We are going to continuously see volatility, but we have to remember that growth in unemployment at this time, especially with the data that we have at our disposal, are going to play a more important role than the inflation data than a lot of these big economists and PhDs are really saying at this current time. Again, when you see everybody freaking out about inflation moving up to like 6.5% or 7% this year, when markets start overcooking things in one direction, typically the opposite is what ends up happening, and we could easily see deflationary effects this year and not inflationary effects, and kind of avoid that stagflation narrative that a lot of people have been worried about. But at the end of the day, you would still see slowing growth and potentially increasing unemployment, and that could lead to the Federal Reserve decreasing interest rates by more than what those current projections have been this year, which right now they're sitting at about they're pricing in about 75 basis points, so 0.75% to about 1% throughout the year 2025. These have been relatively volatile here. We did see for the May Federal Reserve meeting, those projections step up for a rate cut in May to about 40 to 60% at one point throughout last week, and those expectations have dropped back down to 16%. We are going to get that GDP report, a non-farm payroll, and I believe a PCE reading before that next FOMC meeting. For me, I don't think that's going to be enough to really have the Fed cut at the May meeting, but we could definitely expect these cuts to start happening again in June after we have, again, a little bit more time with these tariffs and getting towards kind of the end and some resolutions with a lot of these new trade negotiations and trade policy, and we can really start to see the effects of these new policies. Now, again, I'm not saying guaranteed inflation is not going to go up. It is possible that it does, but we have to be prepared for the case that it doesn't, and it kind of goes against what a lot of the market is expecting right now. So guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot, spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed, turn on notifications so you're notified every time these videos go live. But until next time, guys, I will see you. Peace.